Salam guys, salam everyone, et bonjour, depending on whether you're watching this with your morning coffee or you're stuck in traffic. My name is Osama Lavrusi, but most of you know me as Davlar, the guy who spends an unhealthy amount of time reading balance sheets for fun. I write the Davlar Digest, which is a weekly dose of markets, macro, and Moroccan sarcasm. If you're new here, welcome to the family. Today's episode is about SGTM, which is one of the few companies in Morocco that actually build things on time, which already puts them in the top 1%. So, to set the stage, in this room, I'm walking you through the valuation Excel that I've built for SGTM. No jargon, no headache. Just a simple tour with some storytelling to explain why the numbers matter. If you allow me, let me start with a quick story. You know how in Morocco, if you ask someone when the construction will finish, they tell you, Inshallah. Well, SGTM is one of those rare companies where Inshallah actually means real deadline. They're basically the grown-ups of the construction industry. They show up, they deliver, and they don't run away with your advance payments. So when you value SGTM, you're not valuing a construction company, you're valuing reliability, and reliability is a premium. All right, here's the Excel that you are already seeing here. Don't worry, I won't traumatize you with too many formulas. This is not a McKinsey training camp, okay? So just be cool and relax. Um, the Excel spreadsheet has 7 tabs, as you see. The first one is a README section. The second one is a business plan. The business plan. The third one is inputs. 4 is peers. 5 is valuation methods. 6 is valuation summary. And 7 is research. I do advise you to read the README section. It allows you to see how I structure my Excel spreadsheet. I'm so OCD about certain things when I do my Excel spreadsheets. So whenever you see that there is a yellow background with numbers written in bold red, this means like this is a cell that takes an input. Please feel free to change it if you don't like it. That's your own business. But that's why I have them in yellow. It means I can control the outputs that I want through certain cells that are in this format. The white background with a blue number written in bold, that means this is a formula. And a cell that has a green number inside in bold, that means that that cell is a direct scale from another cell, i.e. it is bringing back the value that is already pre-calculated in another cell. And just a quick forward about valuing companies. This is not an exact science, This is an art, and everything depends on your inputs and acknowledged assumptions. The purpose of this document is to show you and give you a flavor of how I value companies personally, so that when you read an investment prospectus, you know what kind of assumptions you have to look at. And just remember, valuing a company depends on a perspective, on the view of the person that is valuing the company. Valuing a company from a sell side perspective is not the same as valuing a company from the buy side perspective. Then you have a bunch of other things here, like there's some links, to my articles in Substack. I do run an investment newsletter called Davlar, so you can just follow this link and you can find the articles. And please feel free to leave me messages or comments. I'll do my best to reply back to you. Okay, so let's move to the business plan. As you can see here, you have a business plan that goes from 2025 to 2031, which is exactly the same one that was used in the note d'information, la note d'information, or the investment prospectus. So my source here is the investment prospectus. So I'm not gonna go into the details of going into their own assumptions in revenue growth, in margins, capital expenditure, and working capital. You can see that here. They assume, for example, that the EBITDA margin as a percentage of sale, it remains locked at 16.9% here. They assume, for example, that the working capital requirements are going to be locked at 20.8% during the horizon of the business plan. But that's not what I'm trying to show you here. So this is the business plan. This is going to help us build our valuation model. The inputs. For the people who already understand how to value companies, for example, that when it comes to doing a DCF, you have a bunch of like inputs that you have to use and to estimate in order to come up with a valuation. And one of them is how can I compute my weighted average cost of capital and my cost of equity. What I'm trying to show you here, guys, is another way of looking at those assumptions that you have seen in the investment prospectus. For example, as I told you, this is a yellow background and red figure, means it's an input. So what I'm seeing here is Tijari Finance Corp, they took 2.88% as risk-free rates on October 28, 2025. Well, this is not really a big deal, but in the same time, I prefer to have the most updated values. So where can you find them? You can go to the website of Banque Le Maghreb, and they have les taux de référence des bons du Trésor. And you look for the 10-year, and the 10-year here puts us at 3.03%. So this is what I'm using for my risk-free rate. For the unlevered beta, Tijari Finance Corp, they use 0.9. Well, in the world of finance, everyone knows Aswat Damodaran. So this guy is a professor at NYU, and he publishes a certain number of figures, financial figures, that are taken as benchmarks and inputs into a lot of people doing valuation all around the world. Like even in Morocco, they do that. Even investment bankers in Morocco do that. So what I'm also trying to do here is how can I find an unlevered beta that is more appropriate. So I just took the unlevered beta that is mentioned by Damodaran, which is 0.99, and also took an average of unlevered beta of engineering and construction industry with which is around 1.02, and then I just decided to take it 1 instead of taking it at 0.9. I will do maybe next time a video to explain what is this concept of unlevered beta. What is a beta? Does it mean that if I have a high beta, the company is bad or the company is not bad? So, but I'll let that discussion for another recording. As other inputs that I saw, the prospectus, mentions that projected gearing in 2025 stands at 44.94%. And they say that this is close to the historical average, that is observed over the 2023-2024 period, which is 47.02%. Well, first of all, I do think that the historical period is short to infer anything. But for a company that is planning to grow and deliver on its project that are capital intensive, there is a sustainable need to tap into the debt markets. And for that reason, I am using the historical 47.02% that I rounded down to 47 as my gearing ratio. Then you also look at the market risk premium used in the IPO document, which was 6.07%. This one is also interesting. I do feel that 6% is somehow low, but whatever. So I just decided to go with whatever I have available. Again, we can go take Aswat Damodaran market risk premiums that he has published on his website. And then I also take all the market risk premiums, equity market risk premiums that are published by our local banks, and I take an average, and the average is around 6.39%. I'm not using this, and this is something also completely different. I mean, sometimes people, they decide to add premiums on certain specificities that the company might have, which could be specific risks to the company because of X or Y reason. and also something that could be very specific to the construction sector. Um, for me, I'm not using them in my model. Then I calculate the cost of equity, and then I move on and calculate the WACC. Then if we move to this tab, this one is a tab that contains a bunch of peers, a bunch of companies that operate in the same sector that are supposed to be somehow similar to SGTM, and this will allow us to have an idea about certain multiples and have them as a kind of like um, compass, comme une petite boussole that will guide us in our valuation metrics. So what I did is I took the companies that were mentioned in the investment prospectus, and I added some of mine. What I'm doing here that the investment bankers did not do is, instead of using average, I'm using median. I do believe that the median is a very interesting statistical measure, because an average can be biased and it can be skewed upward or downwards by extreme values, by outliers. Whereas when you take a median, you know that you're taking the central value. So that's why I prefer to use the median. So after I have all of this, what I do is, let me just do this like that. So the assumptions here are quite usual. 35% for tax rate, perpetual growth rate 2%. I do recommend that you read my article, the last one on Substack. I noticed something interesting, which I'm gonna share with you. There is no right or wrong answer, and about when you talk about the perpetual growth rate, but usually it is commonly used to say that we take a 2% for a country, for example, like Morocco. And let me show you what happened in SGTM versus, for example, Cash Plus. So in SGTM, this is the investment prospectus. Voilà, je suis en train de parler en français, the investment prospectus. Okay. So the G is something very interesting, because it comes in the denominator of the formula that calculates the terminal value here, and we see that in the investment prospectus, they take it as 2.5%. And the source is the IMF World Economic Outlook April 2025. So far, so good. So far, so good. And it's fine. But then you go to Cash Plus, which also was an IPO that is being handled right now. And guess what you find? G corresponds to the perpetual growth set at 2%. And then they say in line with the IMF's long-term inflation forecast for Morocco. So, and the source is International Monetary Fund and blah blah. Well, let me tell you something. What happens if you increase this one? If you increase this one, means that this difference will become lower. And if this difference becomes lower, means that this ratio is becoming higher, i.e. the terminal value is becoming higher. On the other hand, what about if you decrease this one? If you decrease it, the difference is higher, means the ratio is lower. So what they did for SGTM is they chose 2.5% instead of 2%. So they wanted to increase G to lower this difference, to have a lower denominator, and then to have a higher terminal value. And you can see that. So when you come here, I took 2%, and once you download this Excel spreadsheet, please um, feel free to do your own calculations and just to play with it. I mean, you can do, for example, 2.5% here. And when I do 2.5%, you see here, for example, that the perpetuity cash flows, which is the terminal value, has moved to 71% versus 2%, which is 69%. I want you also to see something else. Look at the implied share price. When it's 2%, it's 353 dirhams. And when I do this, 2.5%, it becomes 375. You see the jump? It's because of that Gordon-Shapiro formula. If you decrease the denominator, you increase the terminal value. And that's why the terminal value here is more than 70% of the enterprise value. So let me come back to the 2%. What you'll see here is something very classic that we use in valuing a company. Um, I'm I'm gonna be looking for the unlevered free cash flows that will allow me to value the observable cash flows within the business plan, which are between 2026 and 2031, and then discount them back, and so as the terminal value. So the discount rate is just the WACC, okay? And then I use this trick here: 1 year, 2 year, 3 year, 4 year, 5, 6, and then you have the discount factor. Very easy, very easy to implement, and then you just have to multiply your cash flows by the discounted factor. Um, then this is the DCF method, and then I can also use an exit EBITDA multiple, which is something very similar, which is similar to a DCF. It combines DCF, but it also combines multiples. So this one only tells me something, which is at this horizon here, after 2031, I want to apply an exit EBITDA multiple through which I'm going to value the company. And then I'm going to bring that terminal value, I'm going to bring this terminal value into today's terms, into 2025. But I'm also summing all the free cash flows between 2025 and 2031. And this is what I'm doing here. So if you come here and you see the enterprise value, only see an NPV, which is a net present value of what you see here between 2026 and 2031. And also you see that I'm taking the EBITDA times the exit EBITDA multiple. And of course, now that we're looking into it, I wanted to tell you something else, and that's why I was like looking. So when you use this, so you see here that there's something called I12, and I12 is EBITDA. EBITDA here. So this normative EBITDA, as they called it here, this normative at the normative level, and you're gonna find it somewhere here. So let me just not lose a lot of time, but I'll do it in another video. So if you can read through here, you're gonna know that the flow calculated on the basis of the latest available cash flow over the business plan horizon. So they're gonna take the last EBITDA and they will increase it by 2.5%, which is why it's also very important when you play with this. You know that's also you're playing on this one. Then I use another method, which is using comparables. The comparables is the peers that you have here. And what I use is the emerging markets only medians for the EV EBITDA for 2025, 2026, and the different PEs. Then I come up with the enterprise value. Of course, for the DCF and for the exit EBITDA multiple and for the EV over EBITDA, you're calculating an enterprise value, but you need to remove the debt so that you can calculate the equity value that you divide by the 60 million share to have the price per share. Then we move to the PE ratios, and in the same, it's benchmark ratios that we apply to the consolidated net income, 25 for 25, 26 for 26, and it gives us an equity value. Then if you want to move to the valuation summary, which is the last thing that I'll be covering with you. So I just summarized here all the implied equity values that I used using the different method, the DCF, the exit EBITDA multiple, DCF, and so on and so forth. With the implied share price, I decided to take an average here, which gives me something around 394, that I'm comparing with the IPO price, which is 380 dirhams. So according to this analysis, there appears to be a little discount between my intrinsic value and the offer price. But on the DCF share price of the investment bankers, as you can see here, it's 445, and you can also see it here. There's a difference of 13%, so their fair share price looks higher compared to mine. But then when I look at the implied multiples, which is EV over EBITDA and PE, I'm like around their numbers. So we're both of us looking at a valuation of 10 times EBITDA on 2025 and around 9.4, 9.8 in 2026. And same for the PE, like we have almost similar values. And just for fun, guys, just wanted to have SGTM and TGCC and Jet Contractors together here. And there's something that I covered in one of my articles, which was about how can you go beyond the price to earnings ratio and look at something else, augmented, like a price to earnings to growth ratio, which is the PEG ratio. This one also allows us to see how much are we paying for the growth. And basically what you take is the price to earnings ratio and you divide it by the growth. You don't divide it by a percentage, but you do divide it by an integer. So if you find that the growth, for example, of earnings here is 32.7%, you just multiply it by 100, and then what you do is like you just take the PE and you divide it by the earnings growth, and basically everything that is below than 1 is an attractive valuation versus the expected growth. So what we see here is it is the case for our HTM. So my final takeaways, guys, for this first video of mine, SGTM's value comes from execution, comes from backlog quality and cash conversion. And I just wanted to share with you this model that can give you a framework. But this is not a prophecy, but it shows how much upside is tied to their discipline and operational strength. If you really enjoyed this kind of breakdown, check out the Davlar Digest, where I mix macro, Moroccan culture, and serious investing with the healthy amounts of humor. And if and and thank you for watching. And yes, I do have a disclaimer. So I'm not a financial advisor. I'm not telling you to buy. I'm not telling you to sell. I'm just sharing with you my thoughts and sharing with you this document because I do believe that we cannot become professional swimmers like Michael Phelps only by watching videos of Michael Phelps swimming and beat people's asses. But we do need, to do certain things by ourselves. Et comme on dit en français, il faut qu'on mette la main dans le cambouis. So that's why I'm sharing with you this Excel spreadsheet because I do believe that by you guys having something like this, it allows you to be more independent. It allows you to play with the assumptions, to play with the inputs, and next time there's gonna be a new IPO, or even for other companies that you have right now, you have more of like a template that you can use to value certain companies. So thank you guys and see you soon.